Okay, so the financial world is officially in shock. A completely unexpected announcement from the White House has just sent markets into an absolute tailspin. And right now, nobody knows what's coming next. So we're going to break down what just happened, why it's such a massive deal, and most importantly, what it all means for your money.
So here it is. It's official. Federal Reserve Chair Jerome Powell is out. But his replacement? Well, it's someone that literally no one saw coming. And the market's reaction? Let's just say it was swift and absolutely brutal.
And I mean, this sell-off was just everywhere. It hit everything. Stocks, gold, silver, even Bitcoin. It all went down, and it went down hard. You know, this signals something huge, a fundamental shift in how the market is thinking. The party's over. The belief that the era of easy money is officially done.
So that brings us to the big question, right? Why all the panic? What does this actually mean for the economy, for investors, and for you? We are going to break down the cause, the real implications, and yeah, even the potential opportunities that might be hidden in all this chaos. It all boils down to one person who's at the center of this whole storm, the nominee for the new head of the Federal Reserve, a guy named Kevin Warsh. His name, and his name alone, is what sent these massive shockwaves through the entire system.
See, Warsh's history at the Fed is what has everyone so on edge. He was a governor right in the thick of the 2008 financial crisis, and he became this really vocal critic of all the stimulus that came after. He was arguing that these massive money printing programs were just a recipe for disaster, for runaway inflation. In fact, he was so against a $600 billion stimulus package back in 2011 that he literally resigned over it. He just walked away in protest.
And that history, well, it defines his entire economic philosophy. In the world of finance, he's what you'd call a hawk. That just means he's all about fighting inflation. He wants higher interest rates and a stronger dollar, even if it means slowing down the economy. So here's the kicker. This is the exact opposite of what markets were betting on for 2026. And that leads us to this total paradox that has Wall Street completely scratching their heads. Why on earth would an administration that has been shouting from the rooftops for lower interest rates go and appoint a famous hawk? It just doesn't add up.
The confusion really comes from this fundamental contradiction. I mean, on one hand, for the past year, Trump has been calling for a weaker dollar. Why? To boost exports, pump up stock prices. But on the other hand, you have Warsh, who has built his entire career on the idea of a strong dollar to fight inflation. You just can't have both. They're polar opposites.
But hold on, because this is where the plot really thickens. Just when you think you've got this guy figured out, his recent public statements seem to completely contradict everything we know about his hawkish reputation.
I mean, listen to this direct quote. He's now on the record saying we could lower interest rates a lot to help with affordable housing. This has a lot of people thinking he's completely flipped his position, maybe just to get the top job. So which one is it? The hawk from the past or this new dove of the present? Who is the real Kevin Warsh?
And this, right here, gets us to what's really going on under the surface. The market panic isn't just about Kevin Warsh. No, it's about the sudden death of something way more important: predictability.
You know, there's one thing you have to understand about markets. They absolutely hate uncertainty. They despise it. When investors have no idea what the Fed is going to do next, they demand a higher return for taking on that extra risk. And how do they get that higher return? Well, asset prices have to come down. It's that simple.
So what we're really talking about here is the market repricing an entire decade of conditioning. For years, investors got used to a certain game. The Fed would always be there with predictable bailouts and support. It created this idea that asset prices only go one way, up. Now, for the first time in a long time, that entire playbook is being thrown into question.
Okay, so if the old playbook is out the window, what's the new one? How should a regular investor even think about navigating this new, uncertain world? Well, let's stop guessing and look at what the data actually tells us.
It's so easy to get scared, right? But we got to start with this idea from the legendary investor Charlie Munger. This kind of volatility, these big swings, they aren't a sign that something is broken. It's just a normal part of how the market works. Being able to stomach it is the price you pay for long-term returns.
And to put that into perspective, get this. Since 1980, the stock market has dropped on average over 14% at some point within every single year. But here's the crazy part. In most of those years, the market still finished with positive returns. Drops like this aren't the exception. They are the rule. And not only are drops normal, But history shows us that markets bounce back, and they do it surprisingly fast. A little 5 to 10% dip, usually gone in about 3 months. A bigger 10 to 20% drop, about 8 months. Even a full-blown recessionary crash is usually erased within 1 to 2 years. Patience really does pay off.
You know, in the short term, trying to make money in the market is basically a crapshoot. But look what happens as you just extend your timeline. Your probability of a positive return goes up and up and up until, at 15 years, it's 99.8%. That's pretty close to a sure thing, right? Time is the single greatest superpower an investor has.
Think about it this way. If the new iPhone suddenly went on sale for 50% off, you'd see it as a huge Black Friday deal, a massive opportunity. But when high-quality stocks go on sale for 50% off, our gut instinct is to panic and sell. It's the only store in the world where customers run for the exits when the prices get slashed.
So this all leads to a really simple but time-tested strategy that is especially powerful when things feel chaotic. First, you just have to change your mindset. Drops or discounts, they're not disasters. Second, keep investing consistently, no matter what. And third, hold on for the long term. Historically, that's just how wealth is built. So, what's the big takeaway from our source material? Well, the conclusion is that the market is probably overreacting. It's just highly unlikely that Trump would appoint someone who's going to actively work against his own economic goals. The most probable outcome is that they're on the same page, and this whole sell-off is based on a contradiction that might not even be real.
But look, regardless of all the political drama, the key takeaways for you, the investor, they stay the same. In the short term, fear will always drive the market more than logic, always. But these fear-driven price drops, they create amazing opportunities to buy incredible assets on sale. And over the long haul, patience is what ultimately builds wealth.
Which leaves us with one last thing to think about. During times like these, when fear is at its absolute peak, what's the true risk here? Is it the risk of losing more if you stay in the game? Or is it the risk of missing the incredible opportunity that comes from patiently buying when everyone else is running for the hills?